So thank you. In today's session, I will explain how I prepare myself every day, what different baskets of stocks I have, where I focus, and some of the trading techniques you can say. I will list those because there are 13 of them and I cannot cover in this webinar. So it's a separate webinar. You can listen on a YouTube channel, the Real Trade Genie. So I'll cover as much as I can in 1.5 hour or maybe 1 hour, 15 minutes. So let's begin. And then I will teach something maybe tomorrow also. So I have allocated Monday, Tuesday, Thursday, and Sunday, these 4 days for teaching something, Monday, Tuesday, Thursday, and Sunday. I may miss some, skip some day, but I try to teach Monday, Tuesday, Thursday, and Sunday around 5 p.m. Thank you. So these two quotes I got a long time ago, 15 years ago, when I was starting trading. So somebody introduced me to the book called The Science of Getting Rich by Wallace Wattle. So it's a very little book. I remember buying it for $6 and I bought multiple copies, probably from Amazon. And then I have a PDF and then it's available on YouTube. So if you have not read this book, read it. It's called The Science of Getting Rich by Wallace Wattle. So in this book, these there are many quotes. So these two quotes, I'm putting it here. Leave every person you come in contact with the impression of increase. Wallace Wattle. So he's talking about the principles of abundance. Number two, you get rich by doing things in a certain way. Wallace Wattle. So this is of course, we have to believe that is true. Some people are really rich and some are not. So there is something going on with those people who are not rich. They are doing certain things in a certain way. They are operating in a different way compared to the person who is wealthy. So, you know, two brothers side by side, one is very wealthy, one is not. Same father, same mother, grew up same. So how come? So they operate differently. They believe in the principles of abundance. One believes and one doesn't. And this is very important. So create value. So by teaching, I by teaching, I believe that I'm trying to create value. If I can teach you something little bit, one sentence which makes you think, then it's fruitful to attend 1 hour session. So this is the quote I always show by Bruce Lee. This is another quote introduced to me that practice one kick 10,000 times instead of practicing 10,000 kicks once. So you don't need to practice 10,000 kicks, just practice one. Then this another quote which is very important. Again, same mentor. His name Chief. When I was starting my trading, so I was there was a time when there was a company, they were selling option software, stock software, forex software, commodity software, and then automated software. So they were selling software, $25,000 package, $40,000 package. People were buying those packages. The market was booming, so so I bought only one. That's where I started. So I thank them that I started by buying a software for $3,000 and losing some money. So I meet some people and they introduce me to the right direction. So one time my chief, I said to Chief, send me something to trade. So he said, okay. And then he sent me email saying, I'm buying 1,000 Home Depot here. So I look at it and I could not figure it out why he's buying 1,000 shares of Home Depot. So I kept quiet. But after a few days, he sent me email saying $3,000 up, LOL. So I opened the chart. and tried to figure it out what is happening, and I could not. So I said, Chief, send me something else. He said, no problem. A few days later, he sent me another symbol, and I ignored that one too. Could not read it. I didn't understand. So if I don't understand, I don't take it, and you shouldn't take it either unless you have a blind faith on that person. So I started following Chief, um, saying, okay, he is up to something. So he explained to me one time that try to read the dinosaurs, the big boys. So if you can see the way they come in the right places they come, you would be in profit. So you're not exactly 100% duplicating them. You don't have that power, but if you follow, you would succeed. So dinosaurs can run but cannot hide their footprints. So their footprints are everywhere, whether from the upside or downside. So both sides, on the top and from the bottom. So who are these? So these are the guys. So there are more. So I listed some. They are institutional players, hedge funds, sovereign funds. Sovereign funds, $1 trillion funds. So sovereign funds, God knows, from Dubai, Qatar, Saudi Arabia, China, sovereign funds, trillions of dollars invested. So when they come in with the right knowledge, imagine how they are moving the market. Pension funds, so they pension companies, they bring the funds in the market. They employ other companies to work for them. High frequency traders, they're just coming in and getting out quick and quick. Immense size and influence. They bring all the sizes. 100,000 shares they're buying. So if I'm buying 1,000 shares, I'm not buying 1,000 shares. Even I'm not buying 1,000 shares. I can push, but I'm buying just 100 shares, then 50 shares, then 30 shares. But I know I need to buy 1,000 shares. So they are not showing 10,000 shares or 20,000 shares. These days, the little computer program can do for them with 100 shares lot, and they will be done. And you would not even know that they bought 10 million shares. Program trading, complex trading studies, all this is going on in the market. And if I think about this, all this is going on in a trader opens his account on a Robinhood and put $2,000 and want to make money, or $500 want to make money. I mean, there are companies who announce that all you need is $500, open the account and make money. All you need is a $500 and a Robinhood account. So that's a bunch of uh, bullshit. $500 will disappear in a matter of minutes. Another thing. So at that time, I opened my account with $2,000. So $3,000 was my software. They gave me 1 month trial for the scanner. I think afterwards they started charging 59. So 1 month was free. And then they told me to open an account with $2,000 on Option Express. So Option Express, I open an account with uh, to buy $15. Doesn't matter if I buy one contract or 10, and to sell one contract or 10, $10, $15, so $13. So I remember I made my first trade while I was working as a consultant right here in San Diego, down Solana, what is Sorrento Valley. I opened my laptop. I saw a symbol named Joe. It was looking good based on their criteria. I bought one contract, $70 I made. Out of 70, I gave $30 to the broker. I made $40, but it looked good compared to my salary of $12,000 per month. I thought, okay, now this is another source. So used to, I was the kind of person who used to go to the office, the first person you would see, the first person coming in the office and the last person leaving from the office. That's the way I was all my life in my career. First person to come in, last person to leave. So once I started learning, I started to leave early. So sometimes I used to stay in a hotel and then I come home, hotel or home, wherever I was, or apartment. And I started accumulating all the books on technical analysis and whatnot. So I was confused. So much to learn, so many thousands and thousands of patterns and thousands indicators and techniques and whatnot. So again, when I reach out to Chief, so Chief Lab, he said, you don't need to learn all these thousands of things. You focus on few things because the thing which moves regularly, the symbols, the the patterns which come again and again in front of you, or the way the stock is moving again and again the same way. They are not once in a while. The one you can rely, the one you can create risk and reward, the one you can read clearly, the one which you know where is the would be the exit, the shorter the time frame for your entry. So this is so important. The shorter the time frame for the entry possible, and in alignment with all the other longer term charts all the way to daily, weekly. So I started focusing on that. So I ignored so many. I I don't know. I ignored, but I did learn. I met another person named Randall, and he taught me about MACD and RSI and stochastic and TMI and Arun and moving averages and all that. So I did learn all that. So I do have some knowledge about those. But then I started putting two plus two together, what works and what doesn't work. So that's what you need to do. What is working, what is not working. Somewhere the volume and indicator, some chart pattern, some trend analysis, some breakout strategy, some support and resistance, all that you combine and create your. So it's like you become a chef, like there's no other dish out there. You are the one, you have your own dish. So the objective for all that, when I started leaving early. I started leaving early from my office. I did many things to learn. I started leaving early. Early means like 6 or 7, when only one or two uh, person left. I remember there was a girl programmer from Hong Kong, Anna. So I used to have a competition with Anna, that who will be leaving late. So I was the last person then, but later Anna was still there. I used to say, "Good night, Anna. See you tomorrow." And then I see Anna early and coming to office before me. So she started beating me because my focus then started to change, that I need to learn something on the side, just not 16, 18 hours just focus on my SAP job. So I come across other books and learn. So this is the definition. I learned that for developing the low risk trade ideas. So the definition. So this is a 4 sentence paragraph, but behind is a lot of work. So think about it. This is just a 4 sentence paragraph, but it has a lot of things, and you have to spend a lot of time to understand and develop your system. So first of all, focus on look at the keywords. A low risk trade idea. So low risk trade idea doesn't mean that it's a low risk 5 cents. It could be that your timing is so perfect that you enter right at the time when that stock is about to just move. It just doesn't. If you're going long, it does not go down. So there's something called adverse excursion. So I'll teach you about adverse excursion and favorable excursion. I'm working on few slides. I'll show you. So you cannot do that. Very hard unless you are a scalper and you can just get in and get out. But the low risk trade idea means that over the long run, it's a low risk. So a low risk trade idea is an idea with a positive expectancy. So positive expectancy meaning if you take 10 trades based on out of 10, let's say eight are winners and 2 are losers. So eight, the gains in 8 and the losers in 2, when you combine them, the overall gain is higher. So the net is higher. So that is traded at an exposure level. So this is another key exposure level that allows you to survive. So this exposure level. So if you trade at if you have a $2,000 portfolio, and you just say, I have $2,000 portfolio and I am putting only 500. So imagine what you're doing. You're putting 25% of your portfolio in one trade. So all it takes is four consecutive trades you take and you wipe out, gone. So think about that, 500, and then so 500, this is what I did. Somehow I made some money in the beginning, so beginner's luck, and then I wiped out. So people don't understand. 500, then they win, so they take it to 2100, then they put another 600, then they take it to 2200, 2500, then they increase the bet to 800, so 2500, they lose at 800, so 2500 becomes 1700, then they take another trade, they put another 800, that's gone. Now they left with 800, 700. So now it's 8, 700. What's a big deal? So they put the trade for 8, 700 and then they wiped out. So it's gone. So so you have to understand what exposure level, the risk, ruin level. So ruin level, exposure level, how much you're exposing. That if one trade or 10 consecutive losers should not affect you. That allows you to survive the worst possible contingency. So the worst possible contingency is what? If you think of in a portfolio, what is the worst possible contingency? So the worst possible contingency is that all your trades become loser, all all of them. If you have 10 trades, all of them are loser and 100% loser. That is the worst possible contingency. So if you have 10 trades open and all the 10 trades are loser, so it can happen, and it happens once in a trader's life due to black swan event. So some kind of an event occurs, especially on the long side. So some kind of a when you are long, some event occurs so that you get wiped out. So you don't want to do that. So in that allows you to survive the worst possible contingency in the short run. So in the short run, those trades gone, but you have enough capital in the account so that you can achieve the long-term expectancy of the system. So even if you suffer the drawdown short term, you achieve success in the long run because the way you are finding, first of all, the way you are finding the trades, your stop losses, your risk, what's the portfolio size. The bigger the portfolio size, the bigger the chance, higher the chance of your survival in this market. So the bigger is the portfolio size is like a China wall. So imagine a China wall where if you have a big capital, it's a China wall. So the China wall, if you fire tennis ball, it will not bring down the China wall. But if you keep firing the cannonball, it will create some dent. But still, you may be able to survive. But even the big cannonballs are being fired. So that tennis ball for the China wall is like these straights, and with the stop loss, they act like a tennis ball on a China wall. But if you happen to put a bigger trade and it becomes a loser, then you may even the China wall will get some kind of a effect. But if you have a very thin wall, so if you have a thin wall, 10, 15 tennis balls, they will bring that wall down. So it's just one or two trade and it's everything is gone. So don't trade like that. So you have to develop your low risk trading game plan. So you have to do that and execute your low risk trading game plan. Now, trading rules, you have to develop the trading rules. You have to have your checklist. So all trades should go through those trading rules and through that checklist so that you can perfectly play your trading game, capitalizing on every low risk trade idea. So if the trade comes to you, and on a scale of 1 to 10, you have a system of scoring them, and it should you taking the trade which qualify as 8, 9, or 10, maybe 9 or 10. You don't even have to take 8. So 1 to 8 gone, only 9 and 10. The everything is lined up. That's the trade you take. Develop the edge in the market. Because if you have a trading rules checklist and you're perfectly playing the game, you are physically fit, you're taking proper diet, you believe in higher power, um, and get excited for the market. So if we go late to bed, we bring we are not prepared for the market in the morning. If we don't have a good sleep, we are not prepared. We cannot trade with full attention the market requires. Market is full of deception, so you have to be really prepared. Just imagine how these fighters, the Air Force guys, how I mean, will they go to fight if they don't have a proper sleep at night? Will they go to fight? So think about that. So have a proper sleep, have a proper diet, have a proper written checklist rules, have some homework done for all your stocks. I'll show you some list of the stocks I have, and I watch them every day. Is to have some process of stocking the trade. So do you have a stocking process? Because stocking the trade is controlling the risk. So there are three factors in your success for trading. One is you, big you, me. And this is number one, which plays about 60% of success. Other 40% is a success related to risk management. And then when you say risk, so there are two main factors in our success: me and risk management. Under risk management or risk control. So under risk control are the factors, the two. One is called position sizing, which how much you will be investing. So you have a little worksheet, you calculate how much you are willing to risk, lose on that based on your portfolio size, based on your risk profile, your age, etc. All that goes into how much you're willing to lose. So out of 100,000, you're willing to lose only 1,000. Then your trading system, your alert is telling you if you lose, how much you will lose. So if you lose 50%, then it means if you're willing to lose $1,000 out of 100,000, then it means you cannot put more than $2,000 in that trade, because when that $2,000 hit the 50% stop loss, you lose 1,000, and 1,000 is equal to 100,000, equal to 1% of 100,000. So then you will be fine. So know that. Monitoring open trades in detailed manner. Do you have a system of monitoring all your trades in a detailed manner on your screen? Have you done something that you can watch all trades? You don't have to watch the charts. I don't watch the charts of the trade. I cannot watch the chart, but I do have a method of watching the price. So I see the price and I read the price, because all you need, if you know that this is the range, that's all you need. You need to know the range. So, you don't need to watch the chart. When something happens, then you click on the chart. Immediately, boom, it goes there, and all your time frames open, and you can see where they are, and all your support and resistance, or your trend lines are lined up, your volumes and other indicators you're using, you lined up. Otherwise, you're just watching the price, only the price, and being very aware of the market condition. So every 15 minutes, you scan the market and see how the market is doing. Every 15 minutes, you go and scan the market. It's like, they when they are running the security of something. So you can see like a parking lot, and somebody in the car, he's driving around here, they're scanning the whole shopping center. So that's what it is. Every 15 minutes, you get up and you say, okay, let me see the market, just make sure everything is okay. And if you're on the short side, and the market condition, and you have some stocks listed in your watch list, and they're not doing anything right now, they're just trading in a tight range. So you're scanning the market, and then the moment the market starts to tumble, then you know, okay, I need to see my watch. The stocks which I plan to go short, they are expected to come down. So you expect that you will get the alert on your support break. So you put some kind of a support alert, and if you're scanning the market, and suddenly you start getting your alert on that this stock is coming down, this stock is coming down. Or maybe you were waiting for your profit exit to hit, and the stock is just trading in a very narrow range, and then you're scanning the market, and then you say, okay, I'm scanning it, market is getting weak, coming down, let me see my this position which is about to hit the target, and I need to go and watch that trade in a detailed manner. So my focus goes only on that trade in a very detailed manner, and I'm ready to exit. So do that. There is another presentation on the 12 or 13 strategies or techniques I use. So, but I listed here so you can learn all this. There are more, so you can learn about these. I have a separate presentation on this topic. It's on YouTube. You can go there, but I just mentioned here. So you can buy a black box. Maybe somewhere it's out there. Chart pattern. You can focus on learning the chart pattern. The chart pattern is very hard because what people try to make something, it's like reading the clouds. Somebody is saying there's a dog out there, you see, and then another person is saying, no, it's not a dog, it's a cat. So the chart pattern reading become like that. Is it a dog or is it a cat? So it takes a lot of time to understand clearly if it's a dog or it's a cat. Band trading strategy, whether the stock is trading in the range. Trend trading strategy, whether some kind of established trend is there, whether you're going against the trend or whether you're going in the direction of the trend or whether you're reading the change in the trends, all that. Support and resistance trading strategy, you need to understand support and resistance. It's very important. Trading is about support and resistance. That's where the buyers and sellers are. Breakout strategy, this is my favorite. The breakout where the stock is moving away from from the some area. So just get telling you, I want to get out of this place. So that's you may want to focus. Gap up strategy. So you can combine the gap with the breakout. So I like gap up and gap down. Gap reversal. Sometimes the stock do the gap reversal. So you, especially if it's a gap down. Intraday reversal. Anything turning around intraday. They were moving up and now coming down. So Microsoft gapped up, had called, closed it, but now it goes into the watch list of short. And then if we are watching it in the proper level, we catch the intraday reversal, the gap up, and then the reversal happening. And then the reversal happening, and you read that reversal. So you buy puts, and your risk is way just above the high of the day. If you really think that this gap up is done, and now the reversal will take place. So intraday reversal taking place, which could be the gap up reversal. And a strategy I use is moving average breakout. So you can use short-term moving averages for the breakout. So combine all this, combine with all these indicators, combine with volume and your judgment, your skill. That's where the trading, you become a trader. So now I'm learning. So let's say I'm learning all these master chart patterns. I'm learning about Bruce Lee techniques of mastering one kick. Um, Now and then I learn all these trading techniques and indicators and volume and everything. Now I cannot trade 9,000 stock. There are 9,000 stock. I cannot trade. If somebody say our system fires scan the whole 19,000 stocks and send you the alert. Don't do that 19,000 stock scanning and you are trying to trade those 19,000 which you're not aware of. You need to know in advance what is the stock. You have your basket and then you trade those, not the 19,000 universe. 19,000 universe, most of them are junk. They are not coming back after you enter. They are not coming back to your price. It's like buying a lotto. So I categorize the stocks pre-studied in two different categories. Mainly, I'm focused on what I call kings. I show you why I call kings. I just named it. Before I used to call only they were hardcore. They were all part of hardcore. Now I further divided it into kings, queens, and horsemen. So I play chess with my daughter. So so just I said, okay, maybe I can king, queen, horseman, financial stock, oil stock, bio stocks, and then there are some other. stock. So let me explain kings. So if you look, no, let me explain a horseman. So I horseman means these Apple, Airbnb, Amazon, AMD, Baba, Baidu, Coin, CRM, Meta, Tesla. So horsemen, they are always moving, either up or down. So first of all, there are few more horsemen I did not list. I ran out of space here, so I just said, okay, I put only these one, two, three, four, five, six, seven, eight, nine, 10. So I put 10. I think there are about 18. So we all know about they always moving, whether up or down. They have a narrow spread. They are very active. Their options are great. They are wild, and you can read the chart properly. It's all the way to the tick chart. So they have a way, because of all the liquidity and all the action, you can read the tick charts properly. So I call them horsemen. They are on one of my monitor, these 17, 18 stocks. They are on my 18. They are 18. They are on my monitor all the time. So um, I mean, I can flip it and see there, right there, these horsemen. Then there's something called, so when I was preparing a horseman, I found out that there are some stock, they are so high price and the spread is so big that I cannot trade them day trade. I mean, if I buy booking for 2,800 per share, and then the spread, the and I will sell at 27, so or something like that, 28. Like I lose $2, so it's not. I said no, no, I cannot trade these in a day trading, but I keep them. So I keep them for so I can trade options and I can create spreads. So I can create options. Sometimes this even the spread is huge in these stocks, but I need to know they are big. They're big in size. I need to know what they're doing. Maybe I can create a spread. Maybe looking at them, maybe I cannot buy these, but I have a pretty good idea uh, about the other stock. So I have a 9-year-old daughter and a 5-year-old son. So 9-year-old daughter, so I try to mentor her. Also, she's 9. So the other day I asked her, "Hey, daughter, school is off. You come here and sit down and daddy is going to shave, but there are some positions here and they may be uh, moving." So I set some alert on Burlington. So I was watching Burlington and Rost and WMT, Walmart. So I said, I'm putting these alerts. So when the alert comes, you need to alert me. So I set the alert very close and I intentionally so that I can get the alert. And then I wanted her to inform me. So I was not that far. So I came back after 1 minute. I said, daughter, any alert? And then she is not paying attention to the alert. She's doing something else on her iPad. I said, daughter, I see something BURL. She said, oh yeah. So I said, this is Burlington. It's going down. I told you, you need to give me the alert. So she immediately, in my conversation, I was teaching her that all these retail stocks, daughter, the Walmart and Burlington and Ross, they're all going down. So immediately she asked, what about Costco, daddy? So what happened? So I couldn't answer her. So I told her that I think Costco is maintaining its level. It's the most uh, proper. I mean, it's a most strong stock. So that's my answer was. But I said, daughter, I have not looked at the Costco chart recently, so I cannot 100% tell you. But if I have not set the alert, it means it's not going down or going up. So, so you see, what I'm trying to say is that in a retail category, then you need to put all these symbols, the Walmart, the TJ Target, the Costco, all these retailers. Starbucks, etc. So you can immediately go and look at it. So these are the kings. So Costco goes in that. Then there is something queen which I need to keep an eye and I trade. So like Amgen, Boeing, Caterpillar, DE, they belong in one category. Caterpillar, DE, Dollar Tree is in a retail. I have it in my retail. FDX, if I'm watching FDX, then I'm watching UPS also. So if FDX is moving up, let me see what a UPS is doing. If I am trading NOC and I about to close the trade in puts, like on Friday, so I close because NOC moved down sharp and it moved up, and then we bought the puts, and then it came down and we closed. So when I close NOC, I immediately went and I say, okay, let me see the other stock related to NOC. So it was GD. So GD was gapping down, and I believe GD will come down. It's a proper trade from the risk reward point of view for puts. So I open puts in GD. So if I'm looking at CAT, maybe I will look at DE also. Maybe I will look at CMI. If I'm looking at FDX, I will look at UPS. If I'm looking at MGen, I will look at something else, mRNA or MRK or JNJ, something else I will look at. So I have all these stocks in the category, but these queens, these are the big movers. So I put them in one. So I need to watch. Then I make a list of the financial. So financial, the American Express, CME, GS, GPM. So if something is moving, if PayPal is moving, let me see. PayPal is listed twice here. So if PayPal is moving, is what about the Square? If V is moving, what about MA? If GS is moving, what about SCHW, and etc. So I look at all these. So it's in my separate workspace, and I can immediately I put them. Those who take who are worth watching, I start setting support and resistance levels, and I go into the option chain and I also look at the option. What is the option doing? Where is the earning? Where is the support? Where is the resistance? How much they have moved, already moved or not? How they are looking in a 15-minute chart? How they're looking on a 60-hour, a 60-minute chart? What is going on with this group? If this group is moving. Then oil is another category. All of the oil stocks are just getting crushed. So I have no problem with that. So these are some of, there are few, two or three other, like 18, another 18 baskets. So I cannot watch more than 18 stocks in one category. I don't know. I don't need to. If I'm, the people, they put more and more symbols, and they miss out. Like they go to the restaurant. Have you seen people when they go to restaurant, they buy like 10 dishes? Give me this, give me that, give me the shake and give me the Coke, and then bring me the tea or coffee and rice also and the naan also and this and then they don't enjoy. I don't know how they can enjoy like five, six, this dish. Just order one or two. Just enjoy that. Come back later. 2 days later you come back. The restaurant will be here. So if you put 10,000 in stocks in oil, you may not be able to read anything. But if you're reading every day, if you're paying attention to crude stock, you know which way they're moving, which way they were going up, which way they were going down. Sometimes they give you, if the trend is to the downside and you already exited because you expect the support level has reached, you bought the puts and support level reached, and now that stock is retracing to the upside, so it's going up. So you keep writing, you keep drawing the resistance lines that, okay, it's moving up, although I'm out. So when I'm out, I set that level, that this is the level I'm out. Now it's retracing to the upside. So if it's retracing to the upside, I'm fine. I just draw the line, and if it hit, I get the alert. I draw another line, and it goes somewhere else up. And then one day, like 2 day, 3 day later, there's a brand new news on the oil stock, and all of them start crashing. So guess what? I already have done the homework that it starts crashing. The moment it starts crashing, I look at all my charts, flip it, and here goes my entry. Boom, again the same. It will be a different strike, maybe a lower strike because I'm buying puts, maybe a different month. So, but I have this and I can cash them. So think about that. So how you can make the, so once you do this homework, it's like one time. You do the homework one time. So I am very used to, and still very like I really need to know. So I started preparing my Excel worksheet with all the symbols I can and all the questions I can and all the techniques and patterns. I started creating a database and things to do list. So based on, think about this, criteria for your candidates, the market analysis. So those stocks which move according to the market. So market analysis is very important. You have to do the market analysis every day. So I do that market analysis you need to do. And then during the market hour, you really need to know what is happening in the market. Liquidity, all these stocks. If you scan 19,000 stocks and on a and they only trade like 10,000 shares, and the price is $20, and they trade 10,000 shares. So what dent you will make in that market? It's trading at $10. Usually it trades 10,000. So you buy thousand shares for $1, let's say. So you bought $1,000. You bought the 10% of the market. And so, and then it goes to 50 cents. There goes your 50. So don't look at it's only down 50 cents. It's not down 50 cents, it's down 50%. So don't do that. Just play these stocks. These stocks, uh, high price stocks, have they have a price for a reason. These stocks, they are high price, better liquidity, well known, world, for a reason. These stocks, queens, they all of them have a nice price for a reason. These kings, they have a reason. To think about that, you can make money in these. All these horsemen, Apple, Airbnb. If you just focus on horsemen, you don't have to look at. Coin was going up the other day, 2 3 days ago. Coin was just going up, and we traded coin. Then it started to go down. Then we traded puts. So same. Something is happening in these. So you don't need to look at the other. So pay attention to the liquidity, pay attention to the volatility, pay attention to your own technical analysis. People trade IPOs. How can you trade IPO unless you have a rock solid knowledge, and whoever is telling you to buy, they don't have any incentive to make money? You cannot read the chart of a stock which doesn't have any history. So at least 2 years of history. So if you don't have a history, how can you do the technical analysis? And if you think that you can apply fundamental analysis. I mean, what skill do you have to do the fundamental analysis? What skill have you? First of all, have you gone to school to learn financial analysis, investment analysis? Have you worked with the? Is that your job that you can do the analysis? And think about that. You're doing the fundamental analysis. How are you doing the fundamental analysis? By reading somebody's provided data. So you're reading somebody's data, somebody's report. So who is that person? So think about it. It's all bunch of nonsense fed to you, and you're doing the fundamental analysis. But it's still, you can do that. But if you don't apply technical analysis, you're just blindly following. So Apple is going, according to the people, Apple will go to 4 trillion market. But for me right now, since 198, Apple may be going for a 2 trillion market. Apple is going to 162. Maybe it will go to 4 trillion, and it has all the fundamental strong this and that. But the market is telling that Apple is going to 162. I've been telling you for so long. When Apple topped out, it will top out, and it's going to 162. And if it doesn't stop at 160, it will drop to 150. So no amount of fundamental analysis can stop Apple from going down. Now, another one, option analysis. So you prepare the candidate and also do some option analysis on it. Some stocks, they're just crazy. There's no good option spread. It's not there. So there are stocks which look really good, but there's no, the options are bad, the spreads are bad. You keep it, I keep it, just so that I know that this is moving, so something else is moving related to it where I can go and get the option. This one, I cannot trade option. I buy, bid is at 1 and ask is at 3. So I don't do that. Do you have a way of doing the sector analysis? Like every day, you know that which sector is gaining momentum to the upside or to the downside, and in that sector, which industry group is weak. So a sector analysis, industry groups, and then based on those, and in those industry group, which stock. So every day you need to know what is the result in this sector, going up or down. Some way of reading the news and catalyst, some kind of a price patterns. So if are you sure you can read the dog in the cloud? Is it a dog or is it a cat? And the reason I give you the example of dog and cat, one day my son, he came and he pulled the paper and pen and he said, Daddy, I'm going to draw something. I said, okay, go ahead. So he drew some circle and he said, ask me, okay, what is it? So I said, looks like a dog. No, it's a cat. So he said, okay, I'm going to draw again. So he drew again. And then he asked me, what is it? I said, it's a cat. No, it's a dog. So the price pattern, which looks to me like a dog, may be looking like a cat to you. And it may be a lion or cheetah. So are you sure you know what pattern it's creating? So just be careful. Do you have a way of understanding the volume? So if you get the alert from someone that buy this, it's $1.10 and it's going to $5, and then you didn't see anything, and you bought 5,000 shares and you created the wave in the market. You were the only one because it only trades 5,000. So think about that. You don't want that kind of stock with a low volume. You need to, you cannot be alone in the market. You have to, people don't even notice you exist. So trading volume pattern, can you read the volume? Can you read the absolute volume? Can you read the relative volume? Do you have a way of reading absolute volume and a relative volume? Think about that. Can you clearly define your risk reward ratio? So where you will jump out in case something uh, goes, so where you will be jumping out. So all that goes into, and then you create your basket. Then you apply the your techniques and the the trading pattern. Now, on other side, I have all this time frame. So they are not all in one workspace. I have all these time frame, time intervals in a different workspace. So think about this. You can put like this. You can create a time frame, a workspace where you have a monthly time frame, weekly time frame, daily time frame, and then you have like maybe you have a 195 time frame. So you have one workspace, monthly, weekly, daily, and 195. And the reason 195, because there are 390 days and 90 minutes in a day. So I just divided it into two segments. So if there are 390 minutes in a day, I can watch 2 bars of 195. So I'm watching half bar, half day, and half day. So combine these four time intervals, monthly, weekly, daily, and 195, it creates one workspace. And then in another workspace, I can have, for continuation purpose, I have 195, 130, 78, and 39. So I have another workspace with the 195 because I see. So it's like a continuation, monthly, weekly, daily, 195, and then 195, 130, 78, and 39. So this is one workspace, second. And then the lowest workspace is 39, 13, 5, and tick time frame. Tick time frame doesn't work for all the charts. If you are watching only these, the tick, for me, at least for me, I don't know about you, but for tick, these are the horsemen, the Apple, the Apple, the Amazon, they can be read. Meta, Tesla, they can be read properly on a tick chart. Otherwise, my lowest time frame is a 5 minute time frame. So 5 minute time frame, I'm looking at it for my entry and exits. So 5 minute time frame, I'm just looking for entry and exit. All others, I'm doing the analysis for my trade. So all this needs to be there. And not only there, but the method of monitoring. When you need to monitor on a detail monitoring, when do you have to do the overview monitoring? So do you do that? Then you need to have a price and volume filters also. So some kind of a filter, some kind of a alert on price, some kind of alert on volume, absolute volume, average, relative volume, some kind of a average true range that the stock moves on in general it moves $2, so it's moving $1.80, so it's already close to that is daily move. So what is happening? Some kind of a change happen in 5 minutes, maybe you get that alert. Some kind of a change in the volume happen. It doesn't mean that I go and jump into it. Change could, how do I, if a change in volume occurred, and then my bias is, so think about it, if the change in volume occurred in 5 minutes and my bias is that, oh, something will happen, is happening, is going up. What if, do you really know if that volume was a buy volume or a sell volume? Just because something is spiked and you see some volume, is it uh, is it is it telling you that it's going up, or somebody just sold and that's why you see the spike in the volume? That could be a climax volume, not the volume which is you think is going up. So think about that. So all this alerts come to me in a different format, and so now I have so not only me but I have team members who support. So their job is to alert me. So opening range breakout, when certain things break from a range, I get the alert. Something make a new high, I get the alert. I get myself also, but my team member, they also get the alert. So they know that what I have told them to watch and inform me. New intraday low made. So if you are short in NOC and it made a new low, then you set a new low, 50, 60, depending on how much, what is the price of the stock. So for some stock, $1 is nothing. For one, 20 cent makes the difference. So based on the size of the stock, you set a new low, and then when it get alert, you get the alert, you see it. Percentage up, percentage down, volume alert. You need to pay attention to the volume, above average volume or way above average volume, unusual volume, below average volume, some kind of a technical analysis on support and resistance. So you clearly reading the support and resistance. Um, you have developed your expertise, so you know the support is being broken or resistance is being broken or support is being reached close to the support or close to the resistance, or what kind of action is happening at resistance to support, sharp reversal from resistance, sharp reversal from support. So you can take some action. Some moving average, have you set up the moving average? So think about that, 50-day, 200-day, 20-day, 10-day exponential moving average. So have you uh, um, you know, have some kind of a setup for these moving averages? Then all this is happening. But one thing which makes the difference is stalking the trade. So it's like two hats. You're wearing two. You have two hats. So you may act like a long-term trader, or you may act like a day trader. So if you are a long-term trader, you still need to act like a day trader, because it will reduce your risk. You will be able to buy more. So it's a mathematical, I have explained in my previous presentation, I'll explain again some other time. Mathematically, you can see by stocking the trade, you reduce the risk and you increase your profit by 200%, by 300%. Same trade, and your profit go same risk, your profit goes up 200%, 300%, 400%. So I'll explain to you next time. I hope I remember I prepare the slide, put a table, and I'll show you how by stocking the trade, how by adopting a proper stocking process and going all the way to a 5-minute time frame, 5-minute time frame. And if it's Apple or Amazon or Tesla or Meta, you can go even to the tick time frame, tick chart. You can increase your profit and reduce your risk. So in other words, even if you're a long-term trader, you act like a day trader. If you're a day trader, you act like a scalper. If you're a swing trader, you still act like a day trader. That's where it is. So what is the definition of stocking? The definition of stocking is, the essence of stocking is to find the best possible price for entry. Best possible price for entry. Thus, stocking is another form of risk control. So behind this form of risk control is the mathematics. So I will explain that mathematics. So if you can listen to other videos on YouTube. So another form of risk control. So and doubling and tripling your profit. So after doing all this, so I'm just giving you example. Let's say I'm watching something and something came up on the screen and I feel good about it. So my tummy, I say, oh, this is the one we need to go long. So I put that on a watch list and I'm watching on my 5 minute chart and I've done the homework on earning, on the options and everything. So I send you the trade alert call is CME. So this is the subject line. So in the subject line, I send you the alert CME calls November 210 buying to open at $5. So that's what I do, buying to open at $5. And in the body of the email, it will there's a breakdown of all this. So stock is CME, month is November, strike is 210, type is calls. So it's a call trade, not a put. So call action to buying to open, not selling to close. So either we are doing buying to open or selling to close for simple option trading. Just doing this leg. When we buy to open, and then we close, sell to close. And what is the price? $5. And if there's no expiry mentioned, then it means it's a third Friday expiry. This is where most of the trades are happening. The open interest is there, the volume is there, and it's a normal option. So third Friday expiry option, buying to open. So third Friday. Now, when I send you the alert, it arrives immediately. I have a Telegram. You can sign up for Telegram and tell us that I've set up the Telegram. Give us your phone number. You start receiving alert on Telegram, and it's instant. So we all of our team members we get it instant, like within like 1 second. The moment we push the button, it arrives on Instagram. So you get you fill your so behind the scene, I don't know if you have a $2 million portfolio or a $2,000 portfolio. I have members who have 2 million, 5 million, and then I have members they join and they have like 5,000. So I don't know what is your portfolio size. So since I don't know, I cannot tell you how many contracts to buy. It's you have to figure it out based on your risk profile. If you need to buy 3 contracts or 30 contracts, so you can buy 1, 2, 3, 4, and then maybe later, maybe more on the dip, maybe just initiate a little bit and see how it goes. So whatever you do, you may try to shape the spread. If it's 5 is the ask and bid is 480 or 470, is 470 is bid and 5 is ask. Maybe instead of putting 5, you put 490 to get fill. 490, 495, something like that in between, and you get fill. The reason you get filled, sometimes the market maker is trying to get you away. So he may be saying, okay, this guy, let him have 490. Maybe the stock move up and down. So it's not like the 5, if everything else equal, 5 is asked, 480 is bid, and everything is constant. So the only time the stock, the ask will come down is when the stock comes down. So the stock is not, unless it's dead right now, is the way I send you the alert or you trading that the stock is not moving. It's just not moving, and then nothing is moving. But the stock is also moving a little bit up and down on a 5 minute chart. You can see it. And when I'm sending you the alert, is right at the time when the stock is about to make its move. So because I'm watching all the way to the 5 minutes. So you buy, you don't cancel, you don't leave it open. You don't leave your trade open for fill. If you don't get fill, you just cancel it. And in next 5-10 minutes, I send you the target. So I will explain the target, and you can see the potential in the trade. Based on the potential, then you can decide how many contracts, etc., to buy. So this is the guideline I have put to pay extra. So if the I hardly trade options between 70 and $1, 70 cents and $1, but sometimes I do. So if I send you, then pay 5 cents more. And if it's a Tesla, etc., maybe or Meta, so maybe the option is trading at 12, so maybe you can pay 40, 50 cents more. It's okay because they move $4 or $5 so it's paying for up to 50 cent extra is okay. So don't so just do something, buy 1 or 2, maybe later you can average down. I also send you alert to average up because it's looking good, and I know something has to why do you average up, so or why you average down? So if I'm long and I'm averaging it down, why I would average down? Because okay, after I bought, the stock pulled back. Now it pulled back to some kind of a support, and now it's reversing to the upside. So it's doing something great. So if if I was not in the trade and I look at that, would I open that trade as if I don't have a, if the answer come yes, so then if I have some money in my account for that trade, so why I'm not buying it average down? People say never, 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 ever, 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 ever average down. I don't know. That's not right. Never, never average down. I, I, I don't believe in that. So if I bought the option at 5 and it dropped to 3, and it is stabilized, and now it's doing its thing and it's really moving up, so why I would not buy at 3? If it's just provided provided that when I bought at 5, I already risk the exposure level. I'm already at 100% exposure level in that trade. Then I have no choice. I'm increasing my exposure. So I'm increasing my exposure by averaging it down. So that's I need to be aware of. Other than that, if it looks like it's a brand new entry trade, I would average down. Also, you can average up. I mean, why if you allotted $2,000 in that trade, and is you have invested $1,000, and now the trade is moving, and it's you have been in the trade for 2 3 days. Suddenly it does a gap up. So it does a gap up and it breaks some kind of a resistance, and it gapped up. It's a the so remember, the stock have many reasons to buy. That's why they keep going up. But there's only some, most of the time there's only one reason for exit, and it's some hell breaking loose in that, and everybody is getting out of the trade at the same time. There is only one door to exit. There are multiple doors to enter. So if you're already in the trade and the trade does the gap up or breaking out, and you can clearly see. So you don't have to buy that strike. You can buy another one or two higher strike. You can buy another month. So do something. You can buy a share. You can create a spread. So averaging it down, you bought at $5. Now it's that option is trading, let's say at 7. So you don't want to buy the same strike, same month at $7. Maybe you say, okay, I'm going to buy another strike, higher strike, and pay $5 for that also. And it's a brand new entry. If I was not in this trade, and if I look at this gap up and it sure looks real good entry, so I would buy some more something, or maybe I create a spread instead of selling it. So do all that. And then when you're creating the target, so don't get in so don't get in the trade when you don't know where you will exit, whether to the downside or whether to the upside. And the stock target determination is science and art. And this science and art, you can use Fibonacci, you can use all kinds of techniques, and you can look at all the twists and turns on your intraday chart. Intraday chart tells you where the previous turning points have happened. So if the stock have made the previous twist and turn at a certain price level, it will do it again. It could be a temporary, but it will do it again. It's not like it will just keep going. So it's like when we are driving the mountain, um, we have to slow down. So we, even though we know we will reach the top, but we have to slow down. So it's everybody is slowing down. You need to slow down. If you don't slow down, you die. So it will. So you know the curve. You have to slow down. So the stock already doing all the twist and turn at that, but it will go through. Sometimes it will make a U-turn, so it's fine, but you know where it's going to the top of the mountain, but all the twists and turns you analyze on an intraday chart. If you look on the day chart, it's just a day chart is a big picture. Intraday chart gives you the the full landscape, full view. So it's like sitting on a bus in front of next to the driver. If you sit at we went on a trip, pumpkin pie last week, and so we had to take our bus ride. So my daughter, I think it was her first bus ride, the long bus. So although we were first in line, and I told the daughter, "Hey, daughter, sit next to the driver and have I." No, 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 we go and sit at the back. I said, "Okay, you don't know. Let's go sit at the back." So she sat way at the back near the toilet. I said, okay, people will not come to use the toilet, but there is a toilet right there, and we are the last one, and we don't see anything except the seats in front of us and a little bit from the side window. So after a while, when the bus moved in like on a land which is not dirt road and is moving and moving and moving, then she realized Daddy was right. So I said, yes, it's okay. You got the experience. You sit in the front, you have a full view. So if you open your intraday chart, a 30-minute or 15-minute, 60-minute, you have a view. You're sitting like sitting next to the bus driver. But if you're looking at a daily chart, weekly chart, you're just sitting way at the back. And in front of you is a gorilla sitting who is blocking everything. So that's the difference you have. So know your exits, entry and at the profit level or at the loss level. So what I do, I create three targets. I provide you three targets and I call them green target, yellow target, and red target. And the reason I do that is because I have members 2 million, $5 million, and I have members of 5, 10,000. So it depends how many contracts they have and the potential. So the way I define my target is again by analogy that if I am going from San Diego and to Seattle, let's say my destiny is Seattle and I started my journey in San Diego. So if I put it on a GPS, hey, GPS, tell me when I will be reaching Seattle, and it will say 3 days and 30 minutes. So that 3 day, 30 minutes or 67 hours or whatever is if I continuously is assuming that I will not stop anywhere, I'll just keep on going and I will reach Seattle from San Diego in 67 hours. But if I put a Jeep, so it's not possible for me. I have to stop and I will arrive in 4 days. But if I put a GPS, if I say GPS, tell me how long it is from San Diego to LA, it will say 57 minutes. So the chances are, unless I screwed up or the traffic, I will arrive in 57 minutes from San Diego to LA. And if I put Santa Barbara, maybe it will tell me you will arrive in 2 hours and 50 minutes. So that's the way it is. If the target, the green target is closer. So when you enter, so the very high probability of something hitting, which is very close. So if you enter at 100 and you say, every time I enter in the trade, I hit the target 100%. Okay, very, very good. You enter at 100, you put the target $100.50. Yes, you hit the target 100% of the time, or maybe, but there is one or two time where the stock just keeps going down and down and down. So you're targeting 50 cents and all your 50 cents goes away because there's one trade which doesn't hit 50 cents, even not a 5 cents from 100. It goes to 80. So you lose. So in other words, the closer is the target, the higher is the probability. So this closer target should not have any resistance in between your entry and exit. It's like a clear sailing. So from San Diego to LA is like clear sailing, especially if it's a Saturday morning. Nobody's on the road, you just keep going, in 55 minutes you arrive. So it hit immediately. So now after hitting the green target, so I send you the alert, and the way I send, so a green target is the immediate target. It has a high probability of stock hitting because it's very close and the momentum is there. So it will hit, chances are it will hit. So, but I don't want you to sell everything on green targets. There's some traders, they just sell everything in green. So they make, so the green target, when it hits, it makes like 25% or 20%. So you sell 20, 25%. But if one trade turns out to be 100% loser, then you need 5 or 4 winners to compensate for that green target winner. So don't do that. But if you have, let's say, 6 contracts, I don't know how many contracts you have. You have 50 contracts, 100 contracts. So you sell 1/3 of them. And the stock is expected to move further towards the yellow target. It means I reach LA, I spend some time, 10, 15 minutes, and then I continue my journey towards Santa Barbara. Santa Barbara, I know I will arrive in 2 hours, something like that. So that is my yellow target. So the second target, I call it a yellow target, and it has a 85. So the probability of hitting yellow target, because now it's is further distance. So if I enter at 100 and the green target was 104, now my yellow target is 107. So in between there are a lot of twist and turn. So just like in between from LA to Santa Barbara, a lot of twist and turn. Maybe it will take for 1 day, 2 day, 3 day, 4 day to finally arrive at yellow target. So so the distance between the green target and yellow target must be some reasonable distance. And the reason, if there is no distance between green and yellow, so if I say I'm traveling from San Diego to LA, so that's my green target. And then I say, okay, let's say my yellow target is Santa Monica. So what happens? Santa Monica is right there. So why bother going for Santa Monica? Why not you selling everything on green? Unless there is no resistance in between yellow and green. So maybe I say, okay, I sell some at green and then I sell more at yellow target. So the distance needs to be greater, some meaningful distance between green and yellow target, because if you're trading shares, there is no time decay. But if you're trading option, there is a time decay for every day. So what you're trying to do is saying, okay, whatever time value I will lose in my option will be compensated by the more by the distance of the stock trading in my. So if I lose 10 cents in my time value, so if I sell, if I bought an option for 5 and I sell at 6 in green target, and tomorrow tomorrow I open the trade, and then the same option is trading at 580. What happened? The stock pulled back a little bit, and the option lost some money. So now it's trading at 580, even though the stock is right there. Now my yellow target is such that I don't mind losing that 520 cents from yesterday, because I know that this option will go from 6 to 8 or 9. So that's the calculation for the yellow target. So the yellow target have some reason for the stock to it's not at the overbought level. So the overbought level has not reached. It doesn't have a strong resistance. It has some more reason to sell to move further. So we send you the alert based on the yellow target. Sell half or sell 3/4. Sometimes we just tell you to sell all because we don't see any. So I look at it and I say no. It took time for the stock. It's like I traveled my intention was from San Diego to Seattle, but I went to Santa Barbara and I took time. And now the whole family is tired. And they said, no, Daddy, we don't want to go. We just turn around, let's go home. So you got so tired when you reach the yellow target, and you spend so many days, and you just want to sell everything at yellow and don't worry about the Seattle. So the way the Seattle trade will work is like this. If I sell everything on yellow target, and I know the stock has a potential to reach the red target, even though I'm not in the trade. I put that stock in stocking mode, because I still know that this trade, I know that it has some potential, but I put some kind of a retracement level alert. I ideally want that the stock which is sitting in Santa Barbara to come back to LA. I don't want him to come back to San Diego, because if it's coming back to San Diego, it's going to Mexico or somewhere else. Because why did it come back to San Diego? You have no business to come to San Diego. If you come to San Diego, you're going to Mexico, Tijuana. I don't want it. I want, okay, it reached Santa Barbara. It didn't go. It looks like it's not going to Seattle. So it's not going to red target. Okay, I'm out. Now I start putting some retracement level, and I just leave it there. But I don't forget any trade which we get out. We don't forget about it right away. We just forget. No, don't forget. It may be giving you the entry on the other side. So there are traders who are always in that symbol. There are traders who are so professional that they are always in the trade, whether long or short. They are so professional that they immediately switch their exit is so good that the exit is such that they know that after their exit, this is done, and now it's time for the stock to go short. So if we are not like that, at least we put that stock on our watch list or on a retracement level. So I start putting on the retracement level and let it come back to LA from Santa Barbara. When it comes to LA, then I start watching, okay, it start to move up. Yes. So now I know, okay, it has started its journey towards Santa Barbara, and now after Santa Barbara, it will go to San Francisco. And so San Francisco becomes my, let's say, my green target because I entered from LA, or Santa Barbara is my green target. San Francisco become my yellow target, and the red target is still there, the Seattle. So I do all this and I send you the alert, sell half, sell majority, or maybe you receive another alert from me after 1 or 2 days. Same alert, same stock with the new target with the new strike. So you will see multiple alerts coming in. So the red target is the ultimate target. So how we define the target? So target is not defined based on what you desire to make money. You cannot tell the market that I want 40% gain if there is only 30% gain. So you cannot tell the market to give me 40%. Like some traders, they say, okay, I when I make 40%, I'm out. Okay, so if that is your system, if that is on the average, you're doing it and it's perfectly fine, but sometimes you after you enter at 40, exit at 40%, and the stock goes to 100% gain, or 200 gain, or something like that, then your 40% exit is not good. So something called favorable excursion. So favorable excursion tells us, if by studying that, how much we give back to the market when we don't time our exit properly. So so how you time your exit, and what you do when it's reaching the ultimate target. For me, the ultimate target, the major resistance, the major turning point, some kind of a major overbought level, major oversold level, some volume climax, some sentiment is changing, something is happening in the market that's telling me, okay, this is your red target, now you need to get out. But when I'm defining it, I call it the target or yellow red target. So because the distance is far, the distance from San Diego to Seattle is far. The GPS tells you 67 hours, but actually you arrive in 5 days because all the twists and turns. You stop in LA, Santa Barbara, San Francisco, and then you made some detour, rested, and then finally you arrive at red target. So it will take time. So if it takes time, the probability is less because it may not go there. It may make a U-turn. So, and the way it is defined is that because it's based on a major resistance, so it has a high probability of doing its reversal, sharp pullback. So because we know that, and if it's a long trade, so it's based on some resistance, some previous turning point, and not only that resistance which you see exists, the resistance can be created while the stock is traveling towards the red target. So the stock, because there are millions and millions of traders, there are millions and millions of complex relationship in the market. A cause B, B cause D. What the trader do, they just say, okay, if when A will happen, then B will happen, then C will happen, then D will happen. The market doesn't work like that. A happen, then your D will happen, and then Z will happen, then it come back to A, then C. So all that is happening. If we are rigid that we say no, the stock is going to Seattle because that's where all I see the resistance. No, because when the stock is moving, all the things are happening. It may create a resistance somewhere between San Francisco and Seattle, and it doesn't want to go back. So the moment you realize, you sell it, and now you know that okay, it's done. This is my big resistance. Now it's not the Seattle, is somewhere below Seattle is the resistance. So you can time your entry for puts. So when it happen like that, I send you the alert to sell, rest, sell off. So I'm explaining, it's very simple when we send you the alert, but behind the scene, behind in my side, in my office, what I'm seeing all this. So I'm based on all that, I'm sending you the alert. So now taking action at red target. So the red target is where you sell everything. You are cash in that symbol. But sometimes in the pre-market hours or after market hours, some news comes out, some brand new catalyst. So when a brand new catalyst comes at, let's say, at the resistance level. So if previously all the traders or investors, they have sold, let's say, Apple at 198, and it made the major top. Now Apple reaching 198, and you have been holding it, and you saw 162, maybe you saw 150. Now you want to sell at 198 and say, so, okay, thank God. But what if it gaps above at 198? Some major news comes up, and some catalyst. So, so it's not prudent to sell Apple at 198. Why would you sell at 198 when there is a major news coming and the Apple gaps above? So think about that. So whenever this kind of situation happens, brand new catalyst, brand new breakout, something that you need to hold. So we send you the alert to hold it, don't sell it. But if it breaks, sometimes the stock does this. It it their sell program, the major seller. So somebody is looking at the retail guy. He see 198 as a resistance. Yes, I know 198 resistance. But then the news comes up and the Apple goes to 201. Boom, 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 it goes up, and then he get excited, and all the other traders, they start buying Apple. But then there is a major seller who who is waiting patiently. He has already told his traders to unleash the sell program, and you see the opportunity when Apple goes 200, 201, you just unleash your sell program, and then the sell program begins, and Apple makes a dive to the downside, and tuck, 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 and then it close, let's say, to 190. So when you see like that, you need to sell um, everything in that stock, sell immediately. So we send you the alert, and you should be watching, but we send you the alert. And sometimes we revise the red target. Why we revise the red target? So we want you to make money, maximize the gain, and markets are dynamic. Maybe the gap above the 200, whenever it happen in future, maybe 1 year down the road, 198 and 200, and then gap up and then keeps going. So we advise when that kind of situation occurs, we say, okay, we are revising this red target, so please hold. We even send you a new trade, new strike, new month, because it's a brand new trade. It's like brand new trade, and whenever it's a brand new like a trade, and then we are already in it, we hold that, or maybe we sell. Maybe we create a vertical spread. Maybe you buy some new strike, new month, etc. So, and then we send you the revised target to the upside for calls, revised target for the downside for the puts, and all the other targets we um, adjust. So we tell you that, okay, these are the targets and we are adjusting, and the target may shrink. So what do you mean by target shrink? So the target was Seattle. Now the target has become San Francisco, because we know that San Diego to San Francisco is enough. It's not, doesn't want to go back to. There may be the market has turned bearish itself. So the market is bearish, so there is no point. So a lot of things happen and we sell. Now the traders, they need to have a multiple reasons for exits and multiple ways of exiting. Must have a power to buy multiple contracts, must have the knowledge and the skill to trade different instruments, different, so sometimes they're trading king, sometimes they're trading queen, sometimes they're trading horseman, oil stock, the future, sometimes the financial stock, sometimes the biotech, all that they're doing, and multiple contracts they can buy, multiple time frames they can watch, and they are laser focused. So based on all that, we have a multiple exits. I send you the alert to sell half or majority. And what else is coming up? Maybe a new position is coming up. So we tell you to sell. Sometimes we give you the price range to sell. Sometimes we tell you to sell by close, because the market is moving so much that we say, okay, we don't know where it will stop, but at least we need to close by the market. So you can close. There is another trigger when a major target is hitting. So the trader forgets, when the major target hits, doesn't matter how good is your position. Your position is a part of that major market. If that major market is hitting some kind of a resistance and it starts pulling back, it doesn't matter how good is your stock, it will also pull back. So knowing that the major target is hitting in the market, and sometimes what happens is the market moves faster and your position has not hit. So if, let's say, the overall market is also traveling towards Seattle from San Diego. So the market reached Seattle first, and your position is still sitting in San Francisco, and you have not reached the red target. So if you ignore that phenomena of the market hitting the major target, and sometimes not even that stock belongs to that market, it could be another market, but all markets are related, interrelated, so it will eventually have an effect on the market where the stock is part of. And because the stock is part of that market will be getting affected, and your stock will be getting affected. So you need to know what else is going on. That's why you need to scan the whole market, like that security guy who goes and sit in the corner, and then he turn on his car, and then he drives to the whole parking lot, move, and then he come back. The same way you go and scan the market, and then you say, okay, no, I need to close my position because the market is hitting the major and the positions are getting pulled back. My stock is looking so good, excellent, but I need to sell. So you need to sell your position. So another phenomena which traders ignore is the pre-market and after-market hour. They are in the position and something is happening in the pre-market or after hour, and they don't notice that. So there may be some major target hitting in the pre-market, or the volume was not there. The volume was not there, and they believe that they listen to CNBC or somewhere, they go and listen, oh, this one is trading at this price, but they forgot that there's no volume, like 200 shares, and it gapped up with that 200 shares, and they go buy and then they get clobbered. So don't do that. Make sure you understand what happened in the pre-market and after-market hours. Some event has occurred. Chances are stock will pull back during regular session if there was no volume in the pre-market hour. The stock must gap above red. So if the Seattle is a major resistance, and next you see is Vancouver. So the way the stock needs to go to Vancouver is not through, like, walk to the border and then it shows a passport and then it goes to Vancouver walk. No, it's like a magic carpet. You just reach the Seattle and take the flight and go to Vancouver. So that's the event, that's the effect it should have. It takes a flight from Seattle to Vancouver, not walk and cross some bridge, slow. If that is happening, you're not going to cross the bridge, you're going to come back and all the way to San Diego. So don't do that. So, in other words, watch the volume, what is happening. It must continue its journey forcefully with the power. And pre-market alert and strategy sent to members. So we are watching it. I watch with my team. They already know. My team is watching 4 o'clock. We start watching four in the AM in the morning. We start watching our positions and other things. So how to maximize gain? Adding to the existing position is a good strategy, whether to average up or average down. Not some, you don't average down for the sake of average down. The traders, they average down just to feel good, just to bring some average cost. So they bought at 10 and now they buy some more at 980, or they buy some more at 940. And then they say, okay, I had a cost of $10. Now my average is 970. So why you have a 970? What good it did from bringing from 10 to 970? You didn't bring it from 10 to 7 or 6. You brought it from 10 to 970 and you increase your risk exposure. Now when you're going to lose, you will lose more. You average down 30 cents, but when you're going to lose, you will lose a lot. So don't do that kind of average down. Have some reason. But you can roll up if the stock gapped up from Seattle to Vancouver, let's say. So it gapped up. So now you know it's in a different territory. So you can sell your strike, the one you have. Let's say you want to sell the one you have, you sell, but then you create another strike way higher. You create a trade with a way higher. If there's not much enough time left in that uh, trade, not many days left, maybe you need to buy another month out. So buy another month out. So if you are already in December and the stock is gap, and you had a strike of 100 and it's trading at 110, you don't buy December 100 strike. You buy maybe January. If you don't have time left for December, you buy January, and don't buy 100 strike. It's already trading at 110. Maybe you can buy 107, 50, or 105, or maybe if you're out of the money, something like that. Don't need to buy 100. Don't need to buy maybe December, buy January, something like that. Buy new strike, buy next month. Maybe create a vertical spread, sell the short call. So if you're already in 100 and the stock is trading at 110, you're already in profit. You can sell the strike maybe 112 or 110. You create a vertical spread. Now you created it, and the rest you're just riding it. So sell some 115 strike against your spread, against your long position. We also send you update during the so if some breakdown is happening, let's say, or some breakout is happening, so we send you the alert that this breakdown is expected. This is the support level. If this support level is broken, it's going. For instance, NOC, when we were trading NOC just Friday, 478, constantly 478 8 was being held, and we went in the short NOC, I don't know, 483 or something like that. So 478 was constantly being held. So the way it was moving, I expected 470 will break. So, and the target was 469. So knowing that my members, some members, maybe they will be able to add more to the position. So is this news a good news for them? Or maybe a trader who bought at 480 and then he's about to sell at 478. He thinks that 478 is the support, whereas I'm thinking no, 478 will break, and once it break, it will go sharply down to 469. So I'm sending you that alert that 478 is about to break. So maybe you want to hold, maybe you add um, more contract, maybe you add a new strike. So all that we tell you. Volume update, I give you the volume update. If some volume is accelerating, I tell you. I send you the alert on get ready to log gains in the trade. So you're ready to log gains. I want you to maximize the gain. So the moment it's reaching there, I want you to jump the ship. So sometime I send you the alert to buy more. So this is buy more. So all that comes because of the perfect kick. So you should be striving for mastering one kick or two kick, but it needs to be perfect kick. So when you put all this together, what I told you will eventually get there. And I'm still working every day. That's my passion, and I work. So trading mastery. So be adopt one trading strategy and be consistent in your trading strategy. Think about that. Think about if the Bruce Lee has turned into a trader, then what kind of a trader he would have been. Think about that. Are you Bruce Lee? Are we Bruce Lee? If Bruce Lee was a trader, what kind of a trader he would have be? So be consistent in your trading strategy. Be disciplined. Believe in abundance. There's a lot of money to be made. Don't worry about other traders making money. Whatever is written in your faith, you will in your fate it will come. Continuously learn something. Learn after teaching this. I already have the things to do list. I'll go back to my bedroom and I will study something I need to study. Develop adaptation. So be very flexible in the market. The market is doing this, you're doing this. The market is doing that, you're doing that. And patience. So stalking process. Develop the process of stalking. Develop the process of monitoring the trade. Be very patient. So there's the process you need to adopt this mental state and then process. Implement robust risk management. So exposure level, know your profit, know your risk level, know your portfolio size, know your stop level, and have a journal, trading journal. Learn from your mistakes. Have a trading journal and eliminate the trading mistakes. So if you eliminate your trading mistake, your trading is going up, guaranteed. So you need to operate at a 90%, 95% efficiency level, meaning out of 100 trades, you made only 10 mistakes or 15, not the technical mistake, the other stupid mistakes we make, and have a growth mindset. So putting all together, again, the last slide is that mastering the principle of abundance. So read this book, The Science of Getting Rich by Wallace Wattle. That leave every person you come in contact with the impression of increase. You get rich by doing things in a certain way. So do certain things in a certain way, and the rest, it takes care. So I'm trying to do that. Same for you. So this concludes today's session. We talked for 1 hour and 35 minutes. I will see you probably in Monday or Tuesday. Thank you. On the yellow target. Yes. So, so good question. So Manny is saying we provide you green, yellow, and red target, right? But then what we do is we estimate. So we provide you the target in the terms of stock price, not in the option price. Nobody will know what the option will be when the stock target is hitting. You're reading the chart of a stock, not the chart of option. So if you're plotting your desk journey from San Diego to Seattle, it's like you're plotting the journey, the map of a stock. You're not plotting the journey of the option. Options have so many variables behind and it's being calculated. So the main is the underlying itself, and then the volatility and other factors, variables. So it's very hard to estimate. You can estimate the option price for tomorrow or 2 days from now, provided the stock moves, provided all the variables stay constant. This is my distance, this is my delta. So based on delta, you can estimate the price of the option, that I'm buying option at $5 at 100, and at 105 it will be $7, because what I did, I just take the delta and took the distance between 100 and 105 is $5, multiplied by delta. Delta is 50. So I say, okay, it's $2.50 increase in my option. So that is my target. Now that target is ask. Now I need to subtract the spread between ask and the spread. If it's a 20-cent spread, then my option will increase not by 250, by 230, but it still is just a guess. So what we do, instead of giving you option target for green, yellow, and red, we just give you for one target, yellow. So that option target is just an estimate that by the time the stock hits yellow target, it will have this option. So what we're doing is we're taking the distance between the current stock price and the option price and the target, and reading the delta. So I read the delta, gamma, and all these Greeks in a real time. So my system reads all that and then takes into the consideration. There's a lot of programming behind the scene going on. There's a big team behind. I myself have 14 monitors and 3 computers, so there's a team behind. There's a programming going on. So we are calculating all this and giving you, but we are only giving you based on yellow target, not green and red. So, and then even then it's not 100% accurate because of a lot of things happen. So when that happens, we adjust the prices and tell you that this is going to change. This is not right. We have to adjust the stock. We adjust the option. So all that we monitor. All right. So thank you, and I will see you tomorrow in the market, and I will teach you something probably, God willing, tomorrow night or Tuesday. Thank you. Bye. Thank you, Ellen. Thank you, Manny. And you can always reach me through email. Thank you. Bye.